Listen, if you're holding physical silver right now, what I'm about to share could be the difference between protecting your wealth and watching it evaporate. And I'm not talking about the price going down. I'm talking about something far more insidious that's happening right under your nose. You see, while everyone's been focused on gold hitting new all-time highs, silver's been sitting there, quietly accumulating the most explosive setup I've seen in my entire career. But here's what nobody's telling you. The very thing that makes silver valuable is also what makes it incredibly vulnerable right now. Let me explain what I mean. Right now, as I'm recording this, silver is trading around $30 an ounce. Gold just crossed 2,700. That puts the gold to silver ratio at 90 to 1. Historically, that ratio averages around 60 to 1. During the peak of silver's bull run in 2011, it dropped all the way down to 31 to 1. Think about what that means. If silver just returned to its historical average ratio with gold at current prices, we're looking at $45 silver. If it went back to that 2011 ratio, we're talking $87 an ounce. But here's where it gets interesting. And this is what you need to understand. Silver isn't just a monetary metal anymore. It's become absolutely critical to the entire green energy transition, to electric vehicles, to solar panels, to 5G infrastructure. The Silver Institute just released their latest report, and industrial demand for silver hit a record 1.2 billion ounces last year. That's up 23% from just 5 years ago. Now you might be thinking, okay, so demand is strong. That's good for my silver holdings, right? And you'd be partially correct. But here's the problem. And this is where that serious warning comes in. The global silver market is facing a structural deficit. We're consuming more silver than we're mining. Last year alone, the deficit was over 200 million ounces. That's the fourth consecutive year of deficits. The total cumulative deficit over the past 4 years, nearly 700 million ounces. To put that in perspective, that's almost the entire annual mine supply. So where's that silver coming from? It's coming from above-ground stockpiles. It's coming from recycling. It's coming from existing inventories. And those inventories are being drawn down at an alarming rate. Here's what most people don't realize. The COMEX, the major exchange where silver futures are traded, has seen its registered silver inventories, the silver that's actually available for delivery, drop by over 60% in the last 3 years. We're talking about going from over 150 million ounces down to less than 60 million ounces. And that's happening while open interest, the number of contracts betting on silver prices, remains near all-time highs. Let me paint you a picture of what this means. Imagine you're at a bank, and there are 100 people in line, all holding withdrawal slips. But when you look in the vault, there's only enough cash for 20 of them. What happens when everyone realizes this at the same time? That's the situation we're looking at in the silver market right now. But it gets even more concerning. The London Bullion Market Association, the LBMA, which handles the majority of global silver trading, has been incredibly opaque about their actual physical inventories. Unlike the COMEX, which publishes daily inventory reports, the LBMA only provides quarterly updates, and even those are vague. Industry insiders have been raising red flags about this for years. There are serious questions about whether the physical silver backing all those paper contracts actually exists in the quantities claimed. Now, I want you to think about your silver sitting in that safe. You bought it because you understood that it's real money, that it's a store of value, that it protects against inflation and currency debasement. You did the right thing. But here's what's happening that threatens even physical holders like you. The price of silver isn't determined by the physical market anymore. It's determined by the paper market, by these futures contracts and derivatives that trade in volumes hundreds of times larger than the actual physical metal that changes hands. When you have that much leverage, that much paper silver trading relative to physical silver, the price can be manipulated, it can be suppressed, and it has been. There have been multiple investigations and settlements involving major banks manipulating the silver market. JP Morgan paid nearly $1 billion in fines for spoofing the precious metals markets. Deutsche Bank, HSBC, UBS, all have been caught and fined for rigging silver prices. This isn't conspiracy theory. This is documented fact, admitted in court, settled with massive fines. But here's the thing about manipulation. It can only last as long as there's physical metal available to deliver against those paper contracts. Once the physical runs out, Once those inventories are depleted, the manipulation ends. And when it ends violently. Let me take you back to a moment in history that perfectly illustrates what I'm talking about. March 1980. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, had been accumulating silver for years. They understood that silver was undervalued. They understood the supply-demand dynamics. At their peak, they controlled over half of the world's deliverable silver supply. The price of silver went from $6 an ounce in 1979 to $50 an ounce by January 1980. But then the exchanges changed the rules. They implemented position limits. They raised margin requirements. They made it impossible for the Hunts to maintain their positions. The price crashed back down to $10 within months. The Hunts were financially destroyed. But here's what's important. They were right about silver. They were just early, and they were using leverage. Fast forward to 2011. Silver went from $18 at the start of 2010 to $49 by April 2011. What drove that? It was a combination of factors. Quantitative easing was in full swing. The dollar was weakening. But more importantly, there was a massive physical buying surge. Retail investors, particularly after the financial crisis, lost faith in the banking system and piled into physical silver. The U.S. Mint couldn't keep up with demand for silver eagles. Premiums on physical silver exploded, and the price followed. But then came the margin hikes. 5 times in 8 days, the CME raised margin requirements on silver futures. The price crashed from $49 back down to $26 in a matter of weeks. Sound familiar? Same playbook as 1980. Now, here's why this time is different, and why that silver in your safe is both more valuable and more at risk than ever before. The structural deficit I mentioned earlier, that didn't exist in 1980 or 2011. Back then, there were massive above-ground stockpiles. Governments held strategic silver reserves. There was a buffer. That buffer is gone. The industrial demand I mentioned? That's not speculative. That's not going away. Every electric vehicle requires between 25 to 50 grams of silver. Every solar panel requires about 20 grams. The world is mandating a transition to green energy. The International Energy Agency projects that solar capacity alone will triple by 2030. That's not a maybe. That's policy. That's law in many countries. And here's the kicker. Silver mining production has been essentially flat for the past decade. We're producing around 850 million ounces a year from mines. That number hasn't grown meaningfully since 2015. Why? Because most silver, about 70%, comes as a byproduct of mining other metals like copper, lead, and zinc. You can't just decide to mine more silver. It comes out of the ground attached to other metals, and those base metal mines take years to develop, require massive capital investment, and are subject to permitting delays and environmental regulations. So we have demand growing exponentially, supply that's essentially fixed, and inventories being drawn down. This is the setup for a supply squeeze unlike anything we've seen in modern markets. Now, let me address something that's probably on your mind. If all of this is true, if the setup is so bullish, why isn't silver at $100 already? Why is it still trading at $30? This is the critical question, and the answer is, what makes your physical silver both incredibly valuable and potentially at risk? The answer is the paper market. As long as the futures exchanges can create unlimited paper silver contracts, as long as the bullion banks can sell silver they don't have, the price can be contained. It's like having a pressure cooker with the release valve stuck open. The pressure builds, but it keeps venting just enough to prevent an explosion. But what happens when that valve finally fails? What happens when the physical market decouples from the paper market? This is what happened in March 2020. Right at the start of the pandemic. For a brief moment, the paper price of silver crashed to $12, but try to buy physical silver at that price. You couldn't. Dealers were charging premiums of $8, $10, $12 over spot. The physical market was saying silver was worth $24 while the paper market was saying $12. That disconnect lasted for weeks. Now imagine that disconnect becoming permanent. Imagine a scenario where the paper price says $30, but you can't buy physical silver for less than $60 or $80, or at any price because there simply isn't any available. This is what's called a squeeze. and the conditions for a historic squeeze are building right now. Let me tell you about what's happening in China, because this is crucial, and almost nobody in the Western media is covering it. China has been on an absolute buying spree of physical silver. Their imports of silver hit record levels last year, over 200 million ounces. That's a quarter of global mine supply. And it's not just the government, it's retail investors. Silver is seen as a safe haven asset in China, and with their property market in crisis and their stock market volatile, Chinese citizens are piling into physical precious metals. But here's what's really interesting. China is also the world's largest producer of solar panels. They're manufacturing the panels, which requires silver, and they're also importing additional silver. They're cornering the market from both ends. And unlike Western investors who are comfortable holding paper silver in ETFs, Chinese buyers want physical. They want it in their possession. This is creating a geographic arbitrage situation. Silver is flowing from west to east, from the COMEX and LBMA vaults to China, and it's not coming back. This is the same pattern we saw with gold for years, and it eventually led to the Shanghai Gold Exchange creating a separate physical gold price that often trades at a premium to London and New York. Now let's talk about what this means for you and that silver in your safe. If you're holding physical silver, you're on the right side of this trade. You have the real asset. You're not exposed to counterparty risk. You're not going to wake up one day and find out that your silver was just a ledger entry that can't be redeemed. That's the good news. But here's the warning, and this is serious. As this squeeze develops, as the disconnect between paper and physical widens, governments are going to panic. They're going to see citizens fleeing their currencies and piling into hard assets, and they're going to respond. History shows us exactly how they respond. In 1933, Franklin Roosevelt signed Executive Order 6102, making it illegal for U.S. citizens to own gold. They had to turn it in to the government at $20.67 per ounce. Then, once the government had collected all the gold, they revalued it to $35 per ounce. Instant wealth transfer from citizens to the government. Now, I'm not saying they're going to confiscate silver. Silver wasn't included in that 1933 order because it was considered an industrial metal, not just a monetary metal. But here's what I am saying. They have other tools. They can impose windfall taxes on precious metals gains. They can restrict the sale of physical metals. They can require reporting of all transactions. They can make it difficult to convert your silver back into currency. And here's something even more insidious that could happen. As the paper market breaks down, as the COMEX and LBMA face delivery failures, they could declare force majeure. They could settle contracts in cash instead of physical metal, and they could set that cash settlement price at whatever they want, regardless of what physical silver is actually trading for in the real world. Imagine you're holding a silver futures contract expecting delivery of 5,000 ounces. The contract price is $30, but physical silver is trading at $80 because there's a shortage. The exchange declares force majeure and settles your contract in cash at $30. You just lost $50 per ounce, $250,000, because you were holding paper instead of physical. This is why physical possession is so critical. But it's also why you need to think carefully about how you're storing it and how you'll be able to access it and use it when you need to. Quick aside here, and this is important for a lot of you watching. If you're sitting on $100,000 or more in retirement accounts, IRAs, 401ks, and you're concerned about everything I'm talking about, I put together a comprehensive guide on how gold and silver IRAs actually work. It's completely free, link is in the description below. It covers how you can get physical precious metals into your retirement account without triggering tax penalties, how the storage works, what the rules are. It's worth checking out if you're in that situation and you want to protect your retirement savings with physical assets. All right, back to what's happening in the silver market. So we've established that there's a structural supply deficit, that inventories are being depleted, that industrial demand is surging, and that the paper market is masking the true physical shortage. Now let me show you what the smart money is doing, because this is always the tell. Central banks have been buying gold at record pace. Last year, they added over 1,000 tons to their reserves. That's the highest level of central bank gold buying since 1950. But here's what's interesting. Several central banks have also been quietly accumulating silver. Mexico, Peru, India, they're all adding to silver reserves. Why would central banks, which have access to the best market intelligence in the world, be buying silver if it wasn't significantly undervalued? Then you have the mining companies themselves. The silver miners are not hedging their production. Normally, when a mining company thinks the price of their product is going to fall, they sell forward contracts to lock in current prices. It's called hedging. But right now, the silver miners have the lowest hedge books in decades. They're not selling forward, they're keeping their exposure to rising silver prices. That tells you everything you need to know about what the people who actually produce silver think is coming. And then there's the ETF situation. The largest silver ETF, SLV, has seen massive inflows over the past year. But here's the concerning part. There are serious questions about whether SLV actually holds all the physical silver it claims to hold. The prospectus has language that allows them to hold unallocated silver, which is basically an IOU from a bank. If there's a squeeze and those banks can't deliver, SLV holders could be left with nothing. This is why the premium on physical silver over the spot price has been elevated for years now. You can see the spot price at $30, but try to buy silver eagles or maple leafs from a dealer. You're paying $4, $5, $6 over spot. That premium is the market's way of saying the paper price doesn't reflect the true supply-demand dynamics of physical metal. Now let's talk about timing, because I know that's what everyone wants to know. When is this squeeze going to happen? When is silver going to explode? And the honest answer is, I don't know exactly when. Nobody does. But I can tell you what the catalysts are, what the triggers could be. The first trigger is a delivery default on the COMEX. If a major player stands for delivery, demands physical silver, and the exchange can't deliver, that's game over for the paper market. Confidence evaporates overnight. Everyone rushes to convert paper to physical. The squeeze is on. The second trigger is a currency crisis. If the dollar loses its reserve status, if there's a major devaluation, if inflation spirals out of control, people flee to hard assets. We saw a preview of this in 2020 when the Fed printed trillions. Silver went from $12 to $30 in a matter of months. The third trigger is a geopolitical event, a war, a major trade disruption, a breakdown in the global financial system. These are the kinds of events that send people scrambling for tangible assets they can hold in their hands. And here's the thing about triggers. You don't see them coming until they've already happened. By the time it's obvious that the squeeze is on, it's too late to position yourself. The premiums are already sky high. The metal is already unavailable. You're chasing the market instead of being ahead of it. This is why I'm making this video. This is why I'm issuing this warning. If you have silver in your safe right now, you're positioned correctly. But you need to understand the risks. You need to have a plan for how you're going to navigate what's coming. And you need to be prepared for governments and institutions to change the rules when they start losing control. Let me give you some practical considerations. First, make sure your silver is in a form that's easily recognizable and tradable. Government-minted coins like silver eagles, maple leafs, philharmonics, these are universally recognized. Generic rounds and bars are fine, but they might be harder to sell in a crisis. You want liquidity. Second, think about your storage situation. If you're keeping everything in a bank-safe deposit box, understand that banks can be closed. Access can be restricted, especially during a financial crisis. Having at least some of your silver in your personal possession in a secure location you control is important. Third, don't put all your eggs in one basket. Silver should be part of a diversified strategy. Yes, I'm bullish on silver. Yes, I think the setup is explosive. But you still need other assets, other forms of wealth preservation. Don't be the person who goes all in on one thing, no matter how compelling the story is. Fourth, understand the tax implications. In many jurisdictions, selling silver is treated as a collectible for tax purposes, which means higher capital gains rates than stocks or bonds. Know the rules in your area. Plan accordingly. The last thing you want is to make a great trade and then lose half of it to taxes because you didn't structure it properly. And fifth, this is crucial. Have a plan for what you're going to do when silver does spike. Are you going to sell some? Are you going to hold it all? Are you going to trade it for other assets? You need to decide this now, before emotions are running high, before you're caught up in the euphoria of a parabolic move. Because here's what happens in every precious metals bull market. It goes up, everyone gets excited, it goes up more. People start thinking it's going to $1,000 an ounce, and then it crashes. And the people who rode it all the way up and all the way back down are the ones who end up with nothing but regrets. Don't be that person. Have a plan. Stick to it. Now let me address the skeptics, because I know there are people watching this thinking, this is just fear-mongering. Silver's been going to explode for years and it never does. This is just another hype cycle. And look, I get it. There have been a lot of false alarms in the precious metals space. A lot of people have been calling for silver to go to $100 for a decade, and it hasn't happened. But here's the difference this time. The fundamentals have never been this compelling. The structural deficit is real. The inventory drawdowns are real. The industrial demand surge is real. These aren't predictions or theories. These are facts, documented by industry organizations, visible in the data. And more importantly, the monetary backdrop has never been this supportive. We have negative real interest rates across most of the developed world. We have central banks that have explicitly abandoned any pretense of fiscal discipline. We have debt-to-GDP ratios that are completely unsustainable. We have a global reserve currency system that's fracturing in real time. All of these factors create an environment where hard assets, tangible stores of value, become increasingly attractive. And silver, with its dual nature as both a monetary metal and an industrial commodity, is uniquely positioned to benefit. But let me be clear about something. I'm not telling you to go out and buy more silver. I'm not telling you to sell your silver. I'm telling you to understand what you own, to understand the risks and opportunities, and to be prepared for what could be a historic shift in the precious metals markets. If you already have silver in your safe, you've done the hard part. You've acquired the physical metal. You've taken possession. You're not exposed to the counterparty risks of the paper market. That's huge. But now you need to think about the next phase. You need to think about how you're going to protect that wealth, how you're going to navigate the potential regulatory changes, how you're going to know when it's time to take some profits versus when it's time to hold. And if you don't have any silver yet, if you're watching this and thinking maybe you should get some, my advice is this: start small. Don't go all in. Don't bet the farm. Buy some physical silver. Take possession of it. Get comfortable with owning it. Understand what it feels like to hold real money in your hands. And then, if the thesis plays out, if the squeeze develops, you'll be positioned to benefit without having taken excessive risk. Because at the end of the day, this is about wealth preservation. It's about protecting what you've worked for. It's about having a hedge against the monetary insanity that's playing out in real time. Silver isn't going to make you rich overnight. But it could be the difference between maintaining your purchasing power and watching your savings evaporate in a currency crisis. The warning I'm issuing today is this: the silver market is more fragile than it appears. The paper price is masking a physical shortage. The inventories are being depleted. The industrial demand is surging. And when this breaks, when the physical market finally decouples from the paper market, it's going to happen fast, faster than most people can react. If you have silver in your safe, you're ahead of the curve. But stay informed. Watch the inventory levels. Watch the premiums. Watch what the smart money is doing. And most importantly, have a plan for how you're going to navigate what's coming. Because this isn't just about silver. This is about a fundamental shift in how people view money, how they view wealth, how they view the relationship between governments and citizens. Silver is just the canary in the coal mine. It's the early warning system for a much larger transformation that's underway. The question isn't whether this transformation is coming. The question is whether you'll be prepared when it arrives. And if you have silver in your safe right now, you're already more prepared than 99% of people. Just make sure you understand what you own, why you own it, and what you're going to do with it when the world finally wakes up to what you already know. Stay vigilant, stay informed, and protect what's yours.